people are saying it's time for that reflation trade in China. Do you believe so?
Actually, after last weekend's the meeting, the Central Economic Work Conference, they did send out a strong accommodative policy. And one thing that we were actually highlighting to clients is that this policy meeting was actually one of the earliest that has happened in the past decade, suggesting that the policymakers are highlighting the urgency that they want two things: stability, and also they want the local governments to set policies in their own settings, but then they need to make sure they have, like, for example, timing-wise, communication-wise, in a better manner, so that they can hopefully manage businesses or consumer expectation.
So go all out then? On China?
Stay selective, though.
Stay selective. Okay.
Yeah.
Well, it's not as if you're
then,
never supposed to be
we
selective.
always
yeah.
like, because for example, in the near term, or actually, we do believe that accommodative policy suggesting that monetary policy-wise might be stay prudent,
okay.
and then fiscal policy will be quite active. But then we continue to like those with like policy tailwinds or policy supportive sectors like decarbonization. That's the thing that we always highlight in near term and or for long term as well. And then also, for example, energy vehicle, and then self-sufficiency in like technology, hardware, and also like technology, supply chain, etc. Those are the ones that we continue to like.
Cool.
In terms of globally, I think you're taking a look at what is equities and corporate credit. You're still very much risk on,
Yes.
and maybe less so when it comes to fixed income and cash. What brings you so much confidence about next year?
I guess next year we still hopefully Omicron still suggests that COVID will still remains to be a risk going forward, but hopefully we actually see this time round with Omicron, even though it's still up in the air, but then we see that businesses, or actually globally, have been adapting it quite well. So we see like demand remain, like even though it's delayed, but it's not destroyed. So hopefully in the next year or so, this might still be a risk, might still be a shock to growth, but going forward, I still think the domestic demand will continue to recover. And then in the backdrop, for example, we see supply chain disruption. This might hopefully subside by mid-year next year. So this will hopefully be some of the supporting factors going forward.
And enough to offset central bank tightening and faster tapering in terms of risk assets, because those don't seem to be supportive of risk assets.
At the moment, we see actually, even though we see Fed tightening, or in this coming week, the whole super week with like 20 central bank meetings, we do see, for example, the Fed probably they might speed up the tapering timeline, and then, for example, market timing, for example, not just one, like 2 to 3 rate hikes next week. But then one thing we always highlight to Asian investors, yes, they can guess like how much hike they're gonna happen next year or so. But one key thing is that even though they're gonna hike, the whole procedure is gonna be gradual, right? And then the whole policy rate will still be actually remain negative, and the real policy rate will remain negative, suggesting that the government bond yields will actually stay close to inflation or just slightly below inflation level.
How long do you think real rates can stay negative, though?
Even though, like, if they're gonna hike, for example, 2 to 3 times, and then terminal rate at 2 to 2.5%, but inflation, because we still see sort of the undercurrent remains quite firm, even though there still be, like, supply chain might subside, but then it might still keep inflation above 2% for US. So suggesting that the real policy rates might remain negative in the near term or so. And so this suggests that investors, Asian investors, global investors will still be hungry for yield.
And does that, I guess in a lot of ways, speaking about credit, then what part of the credit market do you want to be? Because high yield looks expensive, you know, junk bonds look cheap, and there's obviously quite a big gap there, but obviously you have to take more risk, really, in a rising rate environment. So in terms of credit, where do you want to be?
So with credit, we highlight to investors that they need to be selective in terms of like duration risk. They need to manage that because of the rising rate environment. And then we still continue to like high yield. For example, Asia high yield, we might avoid like China, but Asia high yield ex-China might still be quite attractive.
Is China mostly the property story? That's why you're avoiding it right now?
Yeah.
What kind of signs of clarity do you need in order to get back into that part?
I guess with property, we see actually more policy supportive measures coming out. And I guess in the near term, regulatory-wise, we see more clarity in terms of what's going to happen in 2022. 2021 is more like announcing a different regulation. And 2022 might be a year of implementation. But still, we need more clarity in terms of that aspects. And also, I guess, need to highlight to investors or bring back like business expectations to stabilize their confidence, so that might bring more confidence into that sector and also in China in general.
Biggest risk to your outlook that we haven't talked about yet? So we talked about the Fed. We haven't talked about the virus yet. If it's not that, then it's something else. What is it?
I think Omicron is the key risk.
Okay.
And then I guess other than that, that might still be the key risk that we are hanging on to. Inflation is one risk in terms of we do expect that to subside. And we do see, for example, supply chain disruption to hopefully subside. But at the moment, we do see, for example, demand or export figures so far, or on the supply side, for example, the import prices on the PMI sub-indices, so far is suggesting that supply chain disruption has peaked. But then this might still be a risk if other factors arise and might impact the supply chain.